Welcome to another Straight Up Tuesday tip. I'm Tom Shellcross. With me, as always, is Mark Ainley. And with us for, I don't know, is this the fifth time, Mark? I think we have a five-time champion with us now.
I think you do.
Welcome back.
Thank you. Thank you. Very fortunate to be here.
Man, what an honor. We'll get you your plaque, just like the other five-timers. Well, Chris, we're recording this on June 14th. We're approaching the summer solstice. It's almost halfway through the year. Give us the mortgage minute. What is going on compared to where it was 6 months ago? What's on the horizon? Give us a breakdown of the lending industry in the next 10, 15 minutes. Ready, set, go.
Absolutely. There's a lot of great things actually happening behind the scenes. I'll tell you, 6 months ago to today, there's still that supply and demand issue that's out there, because of where interest rates currently are. That being said, behind the scenes right now, if you look at some long-term liquidity and where bonds are trading, some long-term contracts, what we're finally starting to see is the effects of some of the Federal Reserve increase in the federal funds rate, where you're starting to get some investors that are looking at long-term bonds in the 3 to 6 month range out, which tells us that we're going to start to see a decrease in rates here, probably into the winter months and into Q1 for the spring market next year. Why is that so important? So right now, if you are purchasing a house, even though rates are still a little bit elevated and they have come down off their highs, what you'll be able to do is ask your loan officer, or hopefully you ask me because I can lend in almost every state in the country, what is my payment today if I buy, and what is my payment 6 months from now, 9 months from now as rates start to come down? Don't ever forget, your loan officer, I've always done this for 20 years. Anytime you do a purchase transaction with me, I'll always refinance you rate and term at no closing costs. So understand your budget. What adjustments can you make right now so that house is affordable, that rental property is affordable, that primary residence is, and then what is your budget going to look like as rates start to come down? You can only be put into a better position. So it's such a great time. If you find that house, you find that investment property, rents are sky high all over the country. Why are you waiting to make money? Start to make money right now. There's money to be made out there. Buy now, don't wait, because you can always be put in a better position with better cash flow. I'm really, really excited for the first time, probably in about 12 months, really seeing some momentum starting to go the other way. And it's exciting to see.
Well, you said that they're off their all-time high here. Talk to us about an example where rates are right now compared to what that high actually was for someone that might be looking to house hack a 3 or 4 flat.
Yeah, absolutely. So, there was a peak where, depending on some of the FICO factors, LTV factors, depending if you're going conventional FHA, where you were starting to see, rates all the way, 7.25, 7.5, even with fees and points and that sort of thing. For the most part, rates now, at one point a couple of weeks ago, they came all the way down where I was locking a couple of people in the mid sixes. They've been kind of going in that range in the mid sixes to the upper sixes, depending on points, fees, FICO, loan to value, and some different adjustments. So at any point here, we're kind of fluctuating between 0.5 to 3/4 of a point less than their highs. And what you're also starting to see is a little bit more premium in the interest rates on our side. And what that means is servicers are starting to loosen up a little bit. So those fees at closing are going to start to lighten up as well. So not only are you going to have interest rates continuing to go down, you're going to have loan costs go down. And the reason for that is these servicers know all these loans are going to get refinanced, right? So they're not offering, that's why all these loans have points right now or excess fees, and that's going to start to go away again as well. So interest rates are going to come down. The cost of purchasing is going to come down, and you're going to be in a better cash flow position. So it's really, honestly, an exciting time moving forward for the first time in a long time.
Well, I love your excitement. Was there with FICO score? Was there some sort of change that affects your credit or the interest rate hit based on your credit score recently, or is that a rumor?
Well, no, that actually was going to be put in place, and there was so much backlash to it, mainly because of how the mainstream media portrayed it. There's always been FICO adjustments on conventional loans, conforming loans, whether that be investment property or primary residence. So what was happening is they came out and said, we're going to change those FICO adjustments for people with lower FICOs to not have as large of a hit. And the people with that 720, not quite 740, 760 score, their hits were actually going to go up. So the mainstream media took that and ran with it and said, well, we're going to penalize people with higher credit scores. If you look at the grand scale of what those deductions are and how it impacts clients, I personally believe it wasn't that bad of a move. It was kind of out of date. But there was such a backlash to it, it actually never went into effect. So all that hoopla, we're in the same place we are on adjustments. And the biggest thing you have to realize as a consumer, the person with a 660 credit score and 10% down on a conventional loan is not going to get the same rate as somebody with a 740 credit score and 30% down, right? It's called risk-based pricing. That's always been in effect, and they were just trying to adjust those a little bit, but it never went into effect. But it's also the importance of getting pre-approved early, because if you have something on your credit, me and my team can help you get that up as quick as 1 week. So if you have a 685 credit score, there's a 0.5% difference between a 685 and a 720. I can help that consumer get that up to 720 to make their payment that much lower. So that's why you always want to get pre-approved, even about a month before you're ready to start looking.
Your company, your network expands all around the country. Is there anything happening in your world of lending around the rest of the country that can affect us in Chicago in the next 6 months?
You're starting to see in other pockets a little bit more supply sitting. Typically you'll start to see that in smaller, more rural areas first before it goes into the big cities. So there are some pockets of the country where stuff isn't like here in Chicago, where a nice house goes for sale and there's 17 offers in 15 minutes. So you're starting to see that a little bit. You're also starting to see a little bit more of what I call the new subprime, which is non-QM. You're seeing more and more banks get into the non-QM sector of the 12-month bank statement program for self-employed. It's a little bit more quirky foreign national products, ITIN type stuff. There are some opportunities out there for non-traditional loans. You're starting to see more and more of that come back in. That being said, those products are not like 2004, 2005, where you get to state your income, put no money down, and get the best rate on the street, right? So there are hits to that. It's more expensive. The interest rates are higher, but it still gives an opportunity for somebody to purchase who may not before been able to. So that is exciting too, just to see a little bit more loan products. FHA, which is huge on the house hacking side of things, right? You get a 4-unit property, a 2-unit property, even a 3-unit property we've discussed on previous times I've been on here. FHA has no hits really to the interest rate unless you're in a low FICO area. So there's a lot of times right now, and very exciting too, I should mention, FHA lowered its monthly mortgage insurance. Okay, why is that so big? It's a lot of times the FHA rate and now the new mortgage insurance is about equal to that of conventional. A lot of times with those FICO hits, that 680 credit score, if you're not putting 20% down, it makes so much more sense to go FHA than conventional because you're going to have a much lower payment. I think realtors have a misconception about FHA, that it's harder to get approved or you have to do a secondary inspection. It's all part of the regular appraisal. Anything that came up on that would come up on your inspection that would have to get fixed anyway. And you're allowed higher ratios to qualify, lower income to qualify, lower FICOs to qualify. And when you have a 720 credit score, 10% down FHA, it flies through underwriting. It's the easiest approval of it. So I really think the knowledge base into your agents, a lot of them, maybe not as experienced agents, have to realize in this market with cost and interest rates, FHA is going to probably be more of a 50-50 type situation as inventory comes back, because it just makes more sense for consumers right now. And that doesn't mean 3.5% down. There's plenty of good clients with 800 FICO and 10% down that FHA is it's $300 less a month. So you're going to penalize the borrower, so I do suggest all those agents, when you get a pre-approval letter, call the lender, ask them the questions. What have you collected? How's their credit? Obviously they can't disclose too much, but Yeah, get an idea of who you're working with on the lending side, because it's more about the LO you're working with than the name on the wall. We all have the same products, guys. There's no, it's not 2004 where I'm signed up with Argent. I can do a 228 ARM stated income on a 450 credit score, right? I mean, now everyone's direct Freddie, Fannie, Ginnie. Most companies have servicing portfolios where they can control a little bit more of the pricing on also. So just continue to gain knowledge on every offer.
Got it. Chris, we're 10 minutes in and we haven't said inflation yet. Like that's I would have lost on that over-under bet right there. Talk to us. You're optimistic. Do you see inflation putting a little bug in this? Are we still going to be battling this 3 months from now, 6 months from now?
Well, we are, but not to the factors that we are, and that's some of the headwinds that we're seeing, right? So every time the Fed raises the federal funds rate, okay, and I want to be specific in saying the federal funds rate. Every time the Fed raises interest rates, you turn on the news, they say mortgage rates went up today. Okay, no, they didn't. Okay, there is a trickle-down economics effect from the federal funds rate to mortgage rates, sure. But when the Fed raises rates, they're raising the overnight rate in which banks borrow at, credit card interest rates, car notes. They're not directly raising 30-year fixed rates, okay? A lot of times when the Fed announces those rate hikes, it's sort of like Apple stock, right? Apple beats estimates by, $4 a share. And when they announce that, their stock price goes down, right? Because it's already been overtraded. Anything the Fed's going to do is already traded into the market. Now, because the Fed has made so many increases, it takes anywhere from 3 to 8 months for one rate increase to really have an impact on the economy. And this is why historically you've seen the Fed do 16 rate hikes and then all of a sudden they do 16 rate decreases, because they tend to do too many of them. And the economic information that we stated earlier that we're starting to see is starting to show that those first few Fed rate hikes are starting to have an impact on inflation. One of the big factors yesterday or the day before, China, for the first time in 2 years, cut their interest rates, their overnight lending rate. That's a great sign of seeing that some of this impact is actually starting to hit the market. Usually what China does, we follow when it comes to economic data, because they're such a powerhouse in supplying everything and anything, all over the world. So that was great to see. So I do believe there will be inflation. There's going to be inflation here probably for the next 12 to 18 months, but we're going to start to see it go down. And that's where rates are going to start to come down with it and follow it.
Economics and economist and lender. I love it.
Good
I try.
stuff. Mark, you ready for Chicago Fact?
We are. Today we're playing for Daniel Hans, who bought a t-shirt last month. And Daniel, if we get this, myself or Chris get this Chicago Fact right, you'll get a $50 gift card brought to you by NEGC.
All right. So Chris, I know you spend a lot of time in Mark's office. However, I believe your main office is in Schaumburg. That is correct?
Correct.
All right. So I'll let you guys both chime in on this. Schaumburg is bordered by 8 other suburbs. Oh. That's a lot. I'll give you one off the hook. So name 7 of them. 7 suburbs that touch Schaumburg.
Rolling Meadows, Hoffman Estates, Elk Grove Village, Roselle, Streamwood, Hanover Park.
That's 6.
Palatine.
There it is. There's one more.
Arlington Heights.
Itasca? Itasca.
No. You got 7, so this guy's getting his gift card.
Oh, Elk Grove, Wooddale. Wooddale touches it. Des Plaines touches it.
Oh, I didn't have those on there.
Actually, no. This one I'm thinking Elk Grove. Never mind. But yeah, I got the 7. Bam.
Boom. Inverness was the other one.
Inverness. Oh, I would have got that. I would have got that. That's
I'm glad you got one freebie. Everyone walks away a winner now.
Heck yeah. Daniel Hans, you get it.
I'm glad somebody won. I mean, you just named off basically 20 suburbs in the,
Yeah, that's true. You just named off Cook County. Hoping to win this thing.
You didn't say there's no X's there. So, Daniel, you get a $50 gift card brought to you by NEGC. So, Chris, thanks for coming on again. If this is your 5th time, we'll confirm that. We'll get you out your plaque for being a 5-timer. Tom, thank you as always. Listeners, on straightupchicagoinvestor.com, we now have, we've put on there under the resources, our new Chicagoland Property Managers Best Practices Group. So this is something we had in the past. We're relaunching it. Sorry for the self-managers, specific for third-party managers. So if you're a third-party manager, come on in here and join the group under resources on the podcast website. So Chris, thank you very much. Tom, thank you as always. And listeners, we'll see you on Thursday.
Thank you.
Thanks all.
Appreciate you.